Bitcoin and CBDC. There are a lot of problems with the current financial system, such as access to banking, controlling money supplies, transaction costs, sustainability, and privacy. Blockchain may be able to address some of these problems in the current financial system, and governments across the world have begun to investigate whether a decentralized blockchain solution like Bitcoin or a central bank digital currency, a CBDC, would be the right choice to fix these problems. At its most basic, blockchain is a global distributed ledger or database running on millions of devices and open to anyone, where information can be moved and stored securely and privately. Bitcoin exists as a public, open source, decentralized digital currency that uses blockchain to operate. The management of transactions and issuing of Bitcoin is carried out collectively by the network, removing the need for a central authority or a bank. On the other hand, a CBDC is the virtual format of a fiat currency for a country and is a legal tender issued by a monetary authority. CBDCs utilize private DLT rather than decentralized blockchain. Central banks will issue their CBDC on a permissioned or private blockchain network, which is limited to a select group of approved participants.
The monetary policy for a country that uses Bitcoin means that they're actually not going to have economic levers to pull in a time of crisis. Things like inflation is going to be long-term at zero, while interest rates and exchange rates will be determined by market forces globally. A country that uses CBDC, on the other hand, will still be able to target their own interest rates, which means in a time of crisis that they can influence their inflation rate and exchange rates to match their economy, meaning they can get out of an economic crisis a bit quicker.
Blockchain cannot have all three aspects of decentralization, security, and scalability. Bitcoin offers pure decentralization and security at the expense of scalability. CBDCs have greater scalability potential and an appropriate level of security, but had to forego decentralization as a result. Further, Bitcoin has sustainability issues such as significant environmental impacts of the coin, whereas CBDCs have improved sustainability due to the ability to implement monetary policy.
Personal autonomy. When implementing cryptocurrency, personal autonomy comes to mind and should be kept at the forefront of priority. We contrast DeFi and CeFi in order to distinguish the differences. DeFi allows for full autonomy by all users, whereas CeFi has at least some form of external or private manipulation, such as a state bank, which acts to remove autonomy from its users. Examples of such are El Salvador, which has adapted Bitcoin as a legalized tender, in comparison to China and Sweden's CeFi e-currency. The real winner here is El Salvador when it comes to comparing personal autonomy.
Bitcoin serves as a viable option for less developed countries, especially those with high proportions of unbanked citizens and whose citizens abroad send large sums of money back into the country, such as El Salvador. The President's decision to make the cryptocurrency legal tender was motivated by these factors. It is highly unlikely that more developed countries with established financial systems such as China and Australia would adopt Bitcoin as legal tender, as it significantly reduces central control over the financial system. China as a country is very authoritarian in nature. As such, controllable anonymity is a key feature of China's CBDC. The new digital currency electronic payment system increases the government's surveillance capabilities and control over its citizens and private companies. According to the RBA, cryptocurrencies are unlikely to ever become legal tender in Australia due to their highly speculative and volatile nature. The Reserve Bank is more interested in exploring the utility of CBDC for domestic use and improving international payments.